Good morning. Last evening, the Trump administration in the United States surprised global markets with executing reciprocal tariffs across the globe for all major trading partners. This came as a surprise to most financial markets in all countries involved. We've now entered into a different era of global trade, one that we haven't seen since the dawn of the 20th century. What I'd like to do is provide some implications for macroeconomics, microeconomics, and most importantly, your portfolio and investment decisions. So what does last night's announcement do for world trade? Well, I think most importantly, despite there being an abundance of data released last night, uncertainty in the world really hasn't changed. If anything, it is still very, very high. But on the macroeconomic front, two things are most important with respect to the announced changes in reciprocal tariffs that the United States is executing on imports of trade into the United States. One, first and foremost, it affects prices and therefore inflation. One of the things to note going forward is inflationary pressures building not only within the United States as a tax on consumers, but across the globe. We'll be watching this and the evolution of that very closely over the coming months. Number two, this will have implications on unemployment. Again, not only within the United States, but globally. We will be watching that as well very closely in talking with the companies that we cover and have investments in. I must stress there is a lot of unknown at the company level currently. Those unknowns have to deal with how consumers and consumer behavior will be affected for their products, capital expenditures and the forecast thereof, and as well as costs on those individual companies. With all of these macro concerns, the other thing that we can look to help gauge what pressures are building in the systems are things like credit spreads. Right now, BAA credit spreads are actually relatively stable year to date. We're not seeing any signs of real concern or panic in the marketplace as dictated by corporate bond spreads. Next, let's talk a little bit about the microeconomic issues. From a microeconomic standpoint, we would expect that many companies will sit on their hands for the foreseeable future about having real concrete decisions and plans made about how they will allocate capital and where they will allocate capital to. All in all, we would expect that the changes as announced last night not only have some inflationary pressures, but will have some negative consequences for global growth. All in all, you'll be hearing the word stagflation come a lot from probably the media and a lot of economic pundits out there. That's actually quite normal for this period of time. Longer term, what history has dictated to us is that tariffs are actually disinflationary. Longer term, they have a bigger impact on growth than they do on inflation. But in a transient period of time, and we can call that 6 to 12 months, for example, there will definitely be inflationary pressures, more so in some industries than others. I mentioned we haven't seen this type of effective tax rate on behalf of the United States since the dawn of the 20th century. At that point in time, President McKinley had executed very much a mercantile approach to trading, much like the Trump administration is doing right now, where the design was to grow one's country through exporting more than one is importing. As time went on, the fallacies of that economic policy were truly shown, but the US did undergo this policy for an extended period of time, not only under McKinley, but under Teddy Roosevelt. While that doesn't serve as the best example for the current time, it is the closest proxy that we have to date to deal with. The world is effectively getting smaller through all this, and I think you will find companies and countries respond in kind. So what are the implications for your portfolios and most importantly, your investments? We will see a lot of volatility over the coming days, and I would expect the markets to settle as we kind of get through the month of April and things become a little bit more well known. I would encourage people not to make drastic changes to one's portfolio during this period of time of high volatility. It's generally a losing proposition. Our portfolio managers are doing the same thing. We have taken the days and weeks leading up to today to try to determine where should we put the pin in on valuation of certain securities and be more buyers when people are selling. And similarly, where we have to allocate capital in terms of industries and or companies that have a more stable earnings profile, higher quality balance sheet, and more predictable cash flow. And we're doing those exercises, as I say, right now, but we've really been building up to this since the year has begun. Again, this is going to be a very volatile period of time in the short term, I think, for global markets. But I think the important thing is to not act in haste. And here at Fidelity, we're not doing that either. What we are doing is talking to our companies extensively, trying to get the best picture of what is going to come, not in the coming days or even weeks, but their plans over the next year, 2 years, and beyond. With that, with extending one's investment horizon, I believe you can make more informed investment decisions, have a more efficient and optimum outcome to your portfolio, and as always, staying true to what your portfolio goals are. So with that, it is a different period of time. There is not a great playbook for this historically, but I think with Fidelity's resources and our depth and strength of investment professionals, we'll be able to ask a lot of questions and hopefully come to better answers for the benefit of all our clients. Thank you very much for your time.